and a good morning from New York and a good afternoon from Brussels. My name is Bart van Ark and I'm Chief Economist at the Conference Board, and welcome to our June 2018 version of Economics Watch, our monthly program where we review latest developments in the economy and pick up on some of the hot topics that are of interest for you in your organization, in your business, wherever you are in the world. Today, in addition to the outlook globally, as well as for the US and the euro area and emerging markets, we're going to focus a little bit more specifically on the issue of inflation. Today is actually a special day because we've seen some numbers coming out on inflation this morning on the producer price index here in the United States, and then very importantly today we'll get another decision from the Federal Reserve around a possible increase in the Fed rate. So this is a really good time to talk about inflation. And indeed, we'll spend some time on some of the major questions where and in which sectors of the US economy do we see some of the fastest increases in inflation? To what extent do tighter labor market conditions play a role here in the US, but also in the case of Europe? What indeed is the role of the Federal Reserve and the European Central Bank in controlling inflation growth? And of course, related to inflation, we have a strengthening dollar. And how does that evolve for emerging markets that, first of all, see higher import prices, but also see potential risks for servicing their debt? So there are a lot of questions around inflation. Inflation is still low, but will it stay low, and how rapidly can it increase? What we do in this webcast, of course, is very interactive, so we'd like you to participate, and for that we have a couple of guidelines. First of all, and very importantly, this is an interactive webcast, so we want you to ask questions, and you can do that by putting your question in the chat box at the bottom left of your screen. And please do so throughout the webcast, and we will pick them up during our conversation. You can download the presentation. As always, this webcast has a lot of slides. We will probably not be able to spend a lot of time on each of them, so feel free to download that presentation. Feel free to share it with people in your organization. If you want to see some of the slides, they're sometimes busy, so if you want to see them full screen, just make sure that you click the 4 arrows at the top right of your screen. And then there is always at the end of these webcasts a little evaluation. That's very important for us because it helps us to continue to improve the programs and make it as beneficial to you as possible. And finally, you can share this program. We'll put it on demand on our website about 48 hours after this webcast. And you can again watch it yourself one more time, or you can again share it with your colleagues. And then finally, some of you will be joining this webcast and are eligible for CPE credits. If that's the case, make sure that you type your full name and email address in the space that is provided. Click OK for free pop-ups that will occur during the process. Stay online for the whole webcast, so don't go away. And the credit is, of course, only available if you participate live. Now, today we got a great crowd. I'm joined by 3 of my most favorite. I have a lot of favorite economists, but they're very favorite to me, senior economists, covering, in fact, each of the 3 regions that we're going to talk about here in the studio. On my right, on your left, is Brian Shadkin. Brian is our senior economist for the United States and for labor markets, and a regular feature in this webcast. Welcome, Brian.
Thanks, Bart, and welcome back to Economics Watch.
Yeah, it's great to be back on with the 3 of you. And then we go to Europe in Brussels. We have Ilaria Maselli. Ilaria is our senior economist for Europe, a regular guest on this webcast, and of course we are talking today also on the inflation perspective from Europe. Hi, Ilaria.
Good afternoon from Brussels, everyone.
Hi, and from the Netherlands we've been joined by Abdul Erenbam, and Abdul is our senior economist for emerging markets. So he's basically covering the largest part of the world, basically everything that Ilaria and Brian are not covering. So Abdul, it's great to have you in, and thanks for joining us.
Thank you, Bart.
Okay, good. So with all that introductions done, guidelines given, let's go right away into some of the current trends in the global economy. But before we do that, we actually have a poll question, right, Brian? So let's put a poll question on, and then we'll respond a little bit to that. And that poll question is, I have to see this for myself. Yes, which global business issues are you currently most concerned about? Is it higher energy prices? Is it tight labor markets? Is it a stronger dollar? Is it trade policy risk? Or is it geopolitical risk? So you got 5 choices. There may be other ones, but we're not going to make it more complicated than is necessary. So we'll leave it open for about 5 more seconds to see where you're coming from, and I'll ask each of my colleagues to respond very quickly to the outcome. 5, 4, 3, 2, and now we're done. So the outcome, trade policy risk, perhaps not surprisingly, 41% of you have identified that as the most important risk, followed by geopolitical risk, and much less concerned about higher energy prices, tighter labor market, and a stronger dollar. Brian, surprised, not surprised?
Not surprised at all, given the outcome of the G7 conference and the tensions there between traditional allies. I think it's quite clear that businesses are wondering, what are future trade relationships going to be between the U.S. and Mexico, U.S. and Canada, U.S. and Europe, and U.S. and China? And the result of that is an element of indecision in terms of formulating supply chain strategies.
Yeah. Ilaria, surprised, not surprised?
I'm not surprised either, but I have to say this is part of the challenge of our times, because we are bombarded with news now about the G7, about the new tariffs. So everyone is concentrated on that. But if we want to think about risk, we also have to think a little bit long term, or try to hide away from the noise from the news.
Yeah, very good point. Abdul, how about you?
No, not at all surprised, actually, because this is something which we have been also talking about for a while now, how the trade policy risk is going to affect our outlook. And I think this is also featuring in our latest straight talk, your latest straight talk. So I think I'm not at all surprised, because this is at the moment a major risk for the emerging markets as well as for United States and so on.
Yeah, I find it very interesting, because it is indeed quite in line with what we're saying. If you make a distinction between sort of the economic risks, which were the first few, right? Higher oil prices, the rising dollar, and all those kind of factors. Those economic risks really take a back seat at the moment. The greater risk is about geopolitical and policy risk that you identified as the most important. And I think that is very characteristic of what we're currently seeing in the economy, because frankly, the economy is doing pretty well. We're growing at 3.2%. It will be about a slight downward adjustment from what we were thinking about 2018 a couple of months ago, but it is still about the same rate as it was in 2017. So it's a pretty healthy growth. Economic indicators are still pointing towards strength. Now, not across the board, as in particular Ilaria and Abdul will discuss from the European and emerging market perspective, but certainly in the United States, be it admittedly a bit of a policy stimulated environment, but it does help investment growth, it does help the labor market, it does help a little bit in terms of productivity growth, which gives us relative strength in the economy. So there is really not at the moment an immediate problem at the horizon. That doesn't mean that things are going to be up forever, but recessions do not die of old age, or sorry, long cycles don't die of old age. Recessions usually happen when something, and that is quite often a policy or a geopolitical event, is going to trigger a recession. And that's where these kind of risks come in. The issue is not that, in my view, trade policy risk or geopolitical risk will immediately put the economy off the cliff. It just raises uncertainty, and when an economy is entering a maturing business cycle, we will be at higher risk that it is going to trigger a recession event sooner rather than later. So it's a mixed picture. From an economic perspective, we're doing pretty okay. From geopolitical and policy risk, just the uncertainty is increasing quite significantly. And one of the factors that is a wild card in this respect that we will talk about today is indeed inflation. It's again not a major issue at the moment, but it definitely deserves more attention, and that is why we're paying attention to it today. Just to support that viewpoint, first of all, here is just our global leading economic index. Those are 6 months averages that you're looking at, so you see how over a period of 18 months our leading economic indicators collectively have been strengthening. You also see how much the United States and Europe, certainly until a few months ago, and China have been contributing in a synchronized way to that strengthening of the global business cycle. And that indeed is pointing at that continued strength that we are looking at. When we look at our global outlook as it currently is, you can look at this in more detail on our website, but you can see that, for the world economy, we're looking at 3.2%. That's about the same as it was in 2017, which is represented by the orange dashes. But the upside really is in the case of the United States, where we see 3% growth for the year, even more growth in the second half of the year, which Brian will speak to. Whereas Ilaria will speak to the fact that we're actually seeing some slowdown in the case of Europe and the euro area compared to a year earlier. And Abdul will speak to the fact that indeed emerging markets are a bit of a mixed picture, but overall there is indeed some sign of, I would say, a stabilization in the growth momentum that these economies have on average, and certainly no major signs of acceleration in going forward. Now, Ilaria, maybe you can give, before we go into the US outlook in a bit more detail, as you always do in this webcast, maybe you can give us just a headline on your euro area outlook in this slide, and then we'll ask Abdul the same for emerging markets.
Sure, thank you, Bart. This is the starting point, is the previous chart. So we just released the new figures for the estimate of GDP growth in 2018, and for the euro area this is 2%, and for the UK it's 0.9%. In both cases, but for very different reasons, we decided to bring this estimate down compared to what we had at the beginning of the year. So just to think of where we were at the beginning of the year, we started the year with the memory of the end of 2017, which was some sort of stellar, with a stellar performance of the economy in the euro area. GDP growth was very, very strong. But we have been arguing since then, actually, that this was not compatible with the long-term capacity of the economy. So we didn't expect those numbers to be sustainable in the long term. And this actually is what happened in Q1 and is currently happening in Q2, that the economy is moderating, that these supply constraints are becoming more and more visible. And this is why we decided to put down this number to 2% compared to what we had at the beginning of the year, which was 2.3%. In the UK, of course, the story is different. It's not so much related to supply constraints, but it's more related to the combination of the expected shock from Brexit combined with the fact that the business cycle has been maturing now in the UK for some months, and that our leading economic indicators are giving the signal that the economy is slowing down. And this is driven in particular by two indicators. One is the housing market, and the other one is consumer confidence, which has been negative for many, many months now. So this is a bit the overview in a few words.
So just to be clear, Ilaria, we see a pretty significant slowdown in the second half. Actually, it started in the current quarter, and it's likely to continue the second half of the year. Still, Europe is growing well above its potential, right? So there's no reason to immediately panic. The real question for Europe is that potential growth rate, the medium-term growth rate of about 1.5%, whether we can accelerate that. We're still well above that, right?
Yes, that's a very important point, Bart. Indeed, our estimate for the next 10 years is in the range of 1.5%. So 2% is still very well above this, what we think is the potential of the economy, the capacity of the economy. Now, there's been a little good sign recently in our new economy database update, where we think that there's been a recent improvement in the labor productivity performance of the euro area. So this could be, we will see if that is the case, but could be a good sign that maybe the capacity is improving now.
That's a really good point, yes. So Abdul, let's talk a little bit about emerging markets. It's obviously a mixed picture. There's a lot of countries we are covering here. But if you sort of look at the whole, it's still good, but we don't really see an acceleration in growth momentum now. There's definitely some stabilization and in some cases some real risk on the horizon.
That is correct, Bart, actually. So, of course, we have discussed the trade policy risks earlier, which remains, of course, also it affects the emerging markets. But in addition to that, there are a number of other issues which can hamper the outlook for emerging markets, which includes the rising oil prices and the strengthening of US dollar. Both can have an inflationary effect on emerging market economies, and also some of the macroeconomic fundamentals in large countries like India could be hampered because its current account deficit can accelerate. So if you look at the recent trend in some of the indicators like purchasing managers indices or investor confidence, all of them are pointing to some weaknesses in large emerging market economies. And Brazil has been recovering from its 2 years recession lately. But even there, now you see a kind of losing steam in its recovery because unemployment has been increasing tremendously in Brazil during the last couple of years, reaching about nearly 14% at the moment. that is going to challenge its consumer-driven growth, which has been helping its recovery lately. So there are a number of issues which is overall, which can have a kind of moderating effect on emerging markets in general. A final point is that US dollar strengthening can have an impact on significantly large amount of credit, which the debt which has been accumulated by emerging market economies, which has reached very high levels after the financial crisis Asian financial crisis in the 1990s.
Yeah.
So
go ahead. Yeah. Just finish off, Abdul, please.
So all in all, I think what we are expecting is that the emerging market will end up 3.9% GDP growth in 2018, which is the same growth rate which they have achieved last year.
Yeah. And indeed, this issue of the US dollar, which we will address a little bit more in detail when we talk about the inflation story a little later on, because that's obviously quite important for those countries that are pretty exposed. Brian, I want to go on to the US. So hearing this story on the euro area and emerging markets, the US seems to be way ahead of everybody else, right? At least the major regions in the world. So what is going on? Is the US economy distinctly stronger from a structural perspective, or is the US economy now really benefiting from the policy stimulus, which is the tax cuts that we are now beginning to see happening, as well as the fiscal stimulus, expense stimulus that's happening in the economy, or is it a mix of both?
I would say it's not necessarily a long-term structural advantage that the US has. There are two major factors that have caused our outlook to call for 3.5% growth for the rest of the year, around 3% in 2019. And those two things are A, the fiscal stimulus measures, both the tax cuts and the increased government spending. You simply have more money flowing into the system, and as a result, more economic growth. That's not a policy that can sustain elevated levels of growth over the long term. That can only play in over a shorter period of time. In addition to that, consumer confidence and business confidence are very strong. As long as that is the case, we would expect fast growth to continue. Indeed, labor markets are indicating that consumer confidence will remain high because jobs are being created at a rapid clip. Unemployment is extraordinarily low. We would expect that low unemployment would eventually feed into more consumer spending through the wage growth channel. One potential downside is that the Federal Reserve is going to be normalizing interest rates. There is going to be an interest rate increase today. There will likely be one or two more the rest of the year, depending on inflation and growth dynamics and how those play out during the rest of the year. And I think the other sources of risk are external, both in terms of higher oil and commodity prices, uncertainty around trade policy, and also the question of how will a stronger dollar affect U.S. exports, and also sovereign risks and inflation risks in some key emerging markets, which are critical trading partners.
But it seems the risks are more external. Some of them created by the US themselves, like the trade policy risk in which the US plays a big part, but they're more external to the economy than internal to the economy, where there's a nice combination of a pickup in investment and some productivity growth that we've been recently seeing, and now fueled by fiscal stimulus that is just helping to sort of extend this upward movement, at least for a while.
Right. You definitely have more investment coming into the system. A part of that's due to rising oil prices and increased shale production. But I think the biggest thing is just that because the labor market is doing well, resources are being fully employed. There's starting to be evidence of capacity constraints, particularly in the transportation sector, and we'll definitely get more into that conversation during the inflation piece. But I think in general, the fact that you have confident consumers, the fact that you have a policy environment that businesses view as being favorable, those factors are keeping confidence high. As long as that's the case, you would expect growth to remain high.
So take a few minutes to take us through some of the charts to sort of support this story of a US uptick and pointing at how long can this continue? How long can this business cycle last? And is it possible to leverage it a little bit so that we can grow still solidly into 2019?
So I think there's ample evidence, as this chart suggests, the red line being our consumer confidence index, the green line being the ISM manufacturing composite index, that there's plenty of room that both confidence measures have remained strong. We expect that, along with the stimulus plans, to keep growth above 3% for some time. Labor markets are both a sign of how strong the economy presently is and leads to questions about the sustainability of this current growth epoch. Because the blue line, which shows the unemployment rate, that's now at 3.8%. That's the lowest since 1969. 1969. Mm-hmm. It's not, though, so far leading to a major acceleration in wage growth. You could see that the two measures we're citing, the employment cost index and average hourly earnings, have definitely improved over the last year or two, but those levels are substantially lower than they were at the height of the last two expansions. Some of that is due to lower inflation numbers, though those numbers are increasing, and the real wage growth figures recently reported were similarly dismal. But the bottom line is, at this point, we haven't seen wage growth picking up to an extent that would really curtail business activity. And the question is, at what point does that start to happen?
So one question is what point it happens, but the other thing is that there is quite a bit of variation, right? So one data point that you guys quite often talk about is, first of all, at the higher end of the skill range, there's a wage premium that is going up. And very importantly, there's big shortages of blue-collar workers in the United States, where we see now wage increases going well ahead of this, more in the range of 4% rather than 2.5%. So there's also a structural change in the labor market for more demand for particular functions and much less demand for other kind of occupations.
That's absolutely true. I mean, we're seeing increased wages, particularly among truck drivers. The simple fact is there are many truck drivers retiring, very few entering the labor force. The end result of that situation is that you get a shortage of truck drivers. There's no real reason to think that younger people will start becoming truck drivers simply because of fears of automation down the road. That may only be a short-term career. So the end result of that is a shortage and upward pressure on wages.
But even in the United States, there's no shortage of risk when we look at this chart, right? I mean, this is all not entirely making you feel comfortable.
Right. We have definitely seen some of the market risk we saw earlier in the year begin to dissipate. You can see that the S&P 500 has recovered since some of the lows from January and February, though it's still below the levels that entered the year at. But the oil prices have been mostly rising this year. That's a result of higher global demand. And we're going to start to see U.S. production start to offset some of that upward pressure. But that's still a source of potential price increases and business risk for sure. And then also the dollar index. We saw through most of last year the dollar depreciating. With anticipation of Fed rate hikes, the dollar is starting to appreciate, and the result of that ends up being that U.S. exporters lose competitiveness, and that also creates major emerging market risk as well.
So yeah, but the question here is actually, if you look at the very recent numbers, actually the dollar is actually again weakening a little bit. Oil prices have come down in the last 2 weeks. And the market's actually doing pretty well. So the question is, aren't we back to the 2017 scenario? And then the question is, how long can that last? Because as I said, business cycles don't die of old age, but at some point, something's going to trigger problems.
I mean, I think some of that in terms of the dollar was a reduction in risk connected to the Italian political situation, which had driven up a perception of risk and resulted in a flight to quality to the dollar. But by and large, the Fed is going to be raising interest rates 2 or 3 more times this year. The ECB is unlikely to raise rates at all. So you would expect by and large.
So take us quickly through the forecast chart. And then I'm going to ask Ilaria and Abdul whether their regions that they are looking after, your area and emerging markets, are actually benefiting from this US growth and in what way? So, but first take us through this chart.
Okay, so the key numbers are, for the rest of 2018, expect near 3.5% growth to prevail. A lot of that is being driven by strength in investment that's coming from both equipment, in part as a result of the advantages that the new tax legislation provides, and also from structures, which is largely energy related. We're seeing more drilling rigs go into the ground as oil prices rise, as oil prices are consistently exceeding 60, which is the break-even price. The real wild card here is going to be trade. As the dollar appreciates, as emerging markets in Europe have a slackening in terms of growth pace, as trade barriers are erected, we could potentially see those exports come down. So I think that's a key thing to watch out for during the rest of the year.
Yeah, good point. So Ilaria, when you sit on the other side of the Atlantic and you look at these US numbers, does it make you happy, or does it make our European companies happy, or does it make them concerned? Because there's a big divergence in growth performance now.
Well, I think everyone benefits from growth in the US in general. But if I think about last year, what was really what made the growth in Europe really strong was the fact that there was coordinated at the same time between emerging markets, Euro area, and the US. And now that emerging markets are witnessing a moderation, the Euro area is also witnessing a moderation. We can see that impact, how it's feeding each other. So even though the US is still the largest trading partner for Europe, it looks like the moderation in emerging markets is affecting us, and we are affecting the moderation in emerging markets at the same time.
Yeah, good point. And Abdul, particularly for a lot of emerging markets, this is a double-edged sword, right? On the one hand, the US is a very important trading partner for many emerging markets. At the same time, this is rising rates, increasing inflation, and all those kind of things that emerging markets don't particularly like.
Yeah, that is very true. And I completely agree with what Ilaria just said, that everyone benefits from the US growth. And this is also true with emerging market economies. And we have seen in the early parts of the last part of the last year and early parts of this year that some of the Southeast Asian economies have been benefiting from accelerated exports to United States and other advanced economies. But now what we see as we go on, what we see is that if you look at the contribution of different factors to GDP growth in emerging market economies, it is heavily driven by domestic factors. Domestic consumption has been driving growth. And more importantly, the contribution of net trade, or the export minus import, the net trade has been moving to the negative territory. So that means their growth contribution has been declining. So in going forward, it really depends upon how things are working out in terms of interest rate and US policies and so on. But of course, obviously, the growth in the United States have some positive impact on emerging markets.
So whatever happens to policy, globalization has not gone away, and it can have its positives, but it can also have its negatives. So we're right at the bottom of the hour. So let's use the second half hour for this webcast to zoom in a little bit on this topic of inflation that we all sort of teed up a little bit in the first half. And let's start again with an audience poll question. And the question that should be coming up now is about what you think is going to be the most important driver of inflation over the next year. What you think is the most important driver of inflation over the next year? Is that oil and commodity prices increasing? Is it wages? Is it transportation and warehouse bottlenecks or capacity constraints, as economists call this? The rising US dollar that Abdul just discussed? Is it new trade barriers that may arise? Or is it consumer demand growth, just a lot of demand? And that's quite often a traditional channel of very rapid inflation growth. So take a look, pick the most important one. There's probably more than one, but which is the one that you think is the one we really need to watch as a risk for increased inflation happening? And again, we'll give you another sort of 5 seconds to deal with this. I'm going to ask, starting with Ilaria, Abdul, and then Brian on a first response to this. Okay, I think we're going to close it now. Yes, exactly. Thank you. So again, new trade barriers, big risk, but also big risk for inflation. I'd like to hear what my 3 colleagues are thinking about that specifically. It's really standing out among all the other risks which are a little bit more spread around. Nobody concerned about capacity constraints. Ilaria, let's start with you. Would that be your assessment also, that trade barriers are the most important trigger of inflation?
No, I'm a little bit surprised because I would have answered oil prices. Might be a little bit banal, but if you look at the components of inflation, that's the one that is most volatile and it affects a lot the price changes. So that was not. If I bet on that, I would have lost this time.
Yeah. Okay. Abdul, what do you think of that response?
As an emerging market economist, this is a little bit surprising to me as well. But I understand that perhaps from a US perspective, this makes a lot more sense. The new trade barriers will be one of the important factors. But from an emerging market perspective, I would say rising US dollar and oil and commodity prices are going to have a rather higher impact on inflation in the coming years.
So Brian, I guess the reason why a lot of our attendants are actually putting this trade barrier risk up is just because it's going to be inefficient and expensive. Supply chains are going to be disrupted. Companies would have to source elsewhere than they used to be in the past, and some of that cost is going to be passed on to the consumer. So to me, I agree with what Ilaria and Abdul are saying, but I can imagine why people are picking trade barriers as the most important one.
I can certainly imagine it for all of the reasons you state, but I think our audience are overlooking a critical immediate threat, which is the issue of transportation and warehouse bottlenecks. As we are going to discuss on our upcoming Window on America on the retail sector, a key constraint on the transformation from in-store retail to e-commerce is the capacity of truck drivers, the ability to ship goods on land in an efficient way. Those costs are rising right now due to a shortage of capacity, due to a shortage of warehouse space. And all of that capacity is going to have to be increased as the shift to e-commerce proceeds. So I think this is not just a short-term issue. This is one that's going to play a key role in shaping the future fate and productivity of the American economy for some time.
Right, and I think let's go through the potential. There's a longer list, but I think you're pointing at something very important: short-term risk and there's medium-term risk, and they begin to interact a little bit. And some of the short-term risks are probably more related to some of the things that you were saying: capacity constraints, rising oil prices, and those kind of things. So take us through, what you think are some of the most important threats that we're currently looking at.
So first of all, there's a question of what will happen to wage growth. Low unemployment, that suggests there's upward pressure on wages and prices, but so far that hasn't fed into inflation risk. But that could change very quickly given just how low unemployment is and how tight labor markets are becoming, particularly with regard to specific occupations. There are temporary and permanent factors that both yield increased inflation and reduced inflation. So two factors that control inflation are that as supply chains lengthened over the past few decades, it means that it takes longer for an increase in commodity or intermediate goods prices to be transferred into final demand prices, final goods and services prices. And so what that means is that in an era like right now, where commodity prices are relatively high due to global demand, that's going to have somewhat less of an effect on final goods prices than we would have seen in the past. So that's one factor keeping average inflation lower than it would have been in the past. I think the shift to e-commerce is also playing a role through two channels. First of all, incredibly innovative firms are competing in an increased variety of sectors in the economy, so that increased competition definitely plays a role. And then in addition, it's simply much easier for consumers to compare prices among multiple sellers, and as a result, they can choose the lowest price more easily, especially for more commoditized goods. On the other hand, transportation is the exception to all of this because of the lack of capacity, both in terms of labor and also infrastructure, thinking about roads, thinking about warehouses as well. The Federal Reserve is also going to play a very important role because um, it's currently evaluating a situation where growth is relatively strong, but inflation has not picked up quite in the way that other indicators would suggest. But if the Fed waits too long and inflation does pick up, margins for producers are going to fall and business confidence could very well suffer as a result. So that's a real concern the Federal Reserve is dealing with. For emerging markets, having foreign denominated debt is a potential concern, and a rising dollar could represent a threat both in terms of inflation and in terms of managing debt. And then finally, wage inflation without product price increases creates issues in Europe as well. So that's also
and those issues we're going to discuss in a second a little bit more detail with Ilaria and Abdul. But let's stay with the US for a little while. Here are some of the latest numbers. This morning we had some numbers. So really, the numbers are up, and this idea that inflation is not picking up, we should get away from that. There is definitely an upward trend. How important this is, because if you look at it over time, we have seen some other phases where inflation went up, but then it dropped off again. So what's different?
So let's start now with the green line, which is inflation expectations. There's been a clear rise above the 2% Federal Reserve target over the past year, but we haven't seen that number go much above 2%. And the reason is expectations that the Federal Reserve will come in quickly enough to control any upward pressure in terms of inflation. We have seen higher CPI numbers, but again, those CPI numbers are not the highest they've been during this cycle. You can see that they were higher between 2015 and 2016, partially as a result of higher energy prices during that period. The PCE excluding food and energy, the blue line, that has definitely risen, but that's still below 2%. So I think there's definitely a firming of inflation taking place in the US, which is hardly surprising given the level of demand and wage and the strength of the labor market, but still not to the degree that one might expect given the underlying numbers.
Right, and I think the difference with the previous years is that the economy, the overall fundamentals of the economy are stronger now than they were in previous years, and that is why that upward trend could last and continue. So I think that's why we shouldn't be fooled by the idea, well, this has happened before and it could easily drop off again, which could be the case, of course. Now, there's quite a bit of variation, though, among some of the key sectors, as you already identified earlier.
So the key drivers, both in the last year and the last 5 years. So this chart shows in the blue, average annualized growth over the past year by category. In the red, over the last 5 years. Transportation, housing, healthcare, those are 3 sectors that have experienced limited productivity growth over the last 10 to 20 years. They've experienced relatively little competition from e-commerce, and the result is those end up being the main drivers of inflation relative to other sectors.
Right. We want to go also and see what is the European case. What other major aspect do you want to pick up in the US inflation story?
So I think one other thing just to mention quickly is this idea of the Supplier Deliveries Index, which shows the risk of bottlenecks. In the previous slide, you would see that producer costs in terms of transportation have been a particular source of increase. And this can be shown based on this Supplier Delivery Index, which represents how long it takes for goods to be delivered based on orders. And that has been increasing. That shows the upward pressure that supply constraints are creating. And that shows what's happening in terms of these transportation and warehouse areas.
Right. And then the other thing I can't resist, but I think it is quite important because there's so much discussion about e-commerce dropping prices. And there is indeed some evidence that digital prices, which we're seeing in this chart, are dropping faster than the overall CPI. So that's a downward force that is likely to continue, right?
Absolutely. As e-commerce grows, this digital price index, which is composed of all purchases made online, is likely to continue going down. And you can see that this other CPI, which is weighted based on the frequency of digital purchasing, but includes both digital and non-digital, non-online purchasing. Those sectors have gone down. And you can see that in some of the previous charts based on what's happening to apparel prices. Those are being controlled in a way that healthcare, transportation, and housing costs are not due to the presence of online competition.
Yeah, and there's still early days to see how big this impact is, but it is clearly visible that that online does help to greater transparency and therefore lower price growth.
And how it's going to spread to other sectors, I think that's going to be a big story to see.
Point, right? This is not just Amazon, but it's gradually going to spread across the economy. You're exactly right. So Abdul, let's go to the emerging markets. You already talked about oil prices, about the US dollar. Those are the key forces that are creating potential inflation and some real risks in some of the economies that you're looking at.
Yeah, so in this slide, on the right-hand side, you have the inflation rates in some of the major emerging market economies. And what you see is that, in general, emerging market economies seems to be on a comfort zone with the current rate of inflation. I put that current in quotes, actually, because at the moment it looks pretty okay. There are some exceptions, like Turkey and Argentina, where inflation rate varies from 12 to 25%, while in other economies it is in the range of 4 to 5%. So it looks quite comfortable at the moment. But the interesting thing and the important point which I wanted to raise here is that on the left-hand side, you have the oil prices and the dollar index, the exchange rate of dollar. This is again the dollar exchange rate relative to a basket of currencies, and including advanced economies. So the strengthening of the US dollar and oil prices are the two factors that can evoke a kind of pressure on inflation in the emerging market economies, including countries like India and even Mexico, actually. So the reason is that, for example, India is a country which is a net importer of oil, and its current account significantly been influenced by its oil imports. And the correlation between oil prices and the consumer price inflation in India is as high as a 0.9 or 90% relationship. So there is a very high chance that the inflation could trigger up significantly if oil price continues to increase in the international market. And the other factor is the dollar strengthening of the dollar, which can also worsen the inflationary scenario in some of these emerging market economies, because strengthening of the dollar makes imports to these emerging market economies expensive on the one hand, and on the other hand, there are a number of companies in these emerging market economies which has been enjoying the low interest rates in the international credit market during the last couple of years, which have now changing now, and the U.S. interest rate policies and the strengthening of the dollar will make their debt repayment expensive, and they will have to reallocate their resources. So all these are going to accelerate inflation in the emerging market economies.
So what's going to happen to this oil price? And obviously, some of the countries that you're looking at, particularly the Middle East, they will benefit from this because they can grow supply more favorably in this kind of environment. So there are two ways to look at it. One is sort of, this is demand. This is a stronger global economy, and that's why oil prices go up. The other one is that, supply has been quite a bit constrained. I mean, Middle East countries have been exercising quite a bit of restraint in producing, but they may now open up the tap. Again, what do you think, Abdul? Are these oil prices going to go back up to $80, $90, $100, or do you think they will be constrained within this $60 to $70, $80 range?
Yeah, I think I would go with your second option. That I think it is going to be in the lower range. I don't expect it to go to a very high range as we have seen in the in earlier in 2016 and so on. But even that will have a major impact on emerging market economies in aggregate, because most of the emerging market economies are still, especially the largest emerging market economies, are still net importers of oil.
Mm-hmm. Right. And indeed, some of them are going to suffer from that and others are going to benefit from that. Now, one point that you want to bring up, I think specifically, is that there is this, of course, inflationary risk, and that could lead to interest rate increase and everything else. But the other one is the servicing of debt. And debt actually in quite a few of these emerging markets is becoming a problem.
Yeah, so if you look at this chart, the line which is on this chart, the blue line, which shows the volume of total credit which emerging market has been accumulating since 2008. I mean, we have still not reached to the level of 1997 Asian financial crisis, but still we have been moving to that direction. So the amount of credit which have been accumulated in this emerging market has been significantly large, and the distribution of that, which is the which is the at the bottom, where you see the share of each the non-financial corporations, government, and household debt, and the share of non-financial corporation or the corporate debt as a percentage of GDP has been accelerating substantially over time. So this is offering a major risk to emerging market economies because their debt servicing will become expensive given the US dollar is getting stronger, and especially if they have an interesting aspect of this debt is that increasingly the share of dollar denominated debt is increasing in most of these countries, and overall about 15% of the total emerging market debt is now dollar denominated. So all this dollar denominated debt will be becoming expensive to repay if dollar gets stronger for these emerging market economies.
Yeah, and that's of course the result of the fact that the dollar has been weak for such a long time. So it was kind of favorable to keep US dollar debt, although we have been seeing that was a major cause of the Asian financial crisis that we have been looking at. Now, some people would say this is mainly China, right? And particularly corporate debt is piled up in Chinese state-owned enterprises. But I think your chart here is showing that although China is a big factor in all this, it's not the only factor. It's pretty much spread across large emerging markets.
That is correct, actually. I mean, so overall, the debt to GDP ratio has increased from 100% to 200% in the emerging market economies, and a major part of it is indeed China, which increased from 140% to 256%. But now you look at this, actually, so almost everywhere you see an increase, and I think most emerging market economies have more than 50 to 60% of the GDP has a credit. So it's not a story of China only. For example, in Mexico, it increased by 25% over the last 10 years. So even in a country like Mexico, so from 54 to 78%. So, but in some countries, the good thing is that 80% of this debt, for example, in Mexico is denominated in peso. So that means the risk is less compared to China, where a larger share of the total debt has been denominated in dollar. So the exposure to risk varies from country to country, but in general, the overall credit debt has been increasing everywhere across the emerging market economies.
So which emerging market economies are most effectively responding to this potential big problem?
Yeah, what do you mean by responding? Are they,
well, through policy, through trying to wind down the debt, what policy measures are being taken?
Yeah, China has been trying to compromise on its growth policies and then move forward with deleveraging policies to address its long-standing credit issues. So some of the countries like Argentina, for example, has been doing worse in managing that because it has not been doing very well. So the policy has been also changing from countries to country. Turkey has been doing again worse in the policy scenario on this.
Yeah. Okay, thanks. So Ilaria, I mean, the last region that we would worry about when it comes to inflation would be the euro area. But I think you were saying not quite. We even in the case of the euro area, we've got to be on the lookout here, right?
Yes. So let me elaborate my argument because I had to spend quite a bit of time putting these numbers together and trying to make sense of it. So let me go slow through this. The starting point is obviously the headline inflation. And you can see here on this chart, it was 1.9% in May, according to the flash estimate in the euro area. And importantly, so I mean, 1.9, we haven't seen 1.9 for 5 years now. So it's been a long time since inflation was this close to 2%. But that's one piece of information. The second piece of information is that this month, for the first time, also core inflation went up. And this was 1.5%, up from an average of around 1.2% for the past year. So this confirms that there's been a small upward pressure towards inflation. Now, I put here on this chart also most EU countries, just to have an idea of the heterogeneity we are faced with here. So one thing is worth noting. One is that there is as I said, big heterogeneity. We go from 0 to all the way to 5% in Romania. So this is one thing. The second thing I want to attract your attention to is the fact that in three big Euro area countries, inflation is higher than 2.2%, and this is Germany, France, and Spain. So three large Euro area economies are now seeing inflation higher than 2%.
And what is driving this, Ilaria? What is behind this inflation? Because this is a story not very well told in Europe, frankly. As I said, if you look at the European story, it's always about why is inflation so slow. So what's behind this?
Not told and not entirely understood, I would say. And there is a reason for that. If you go to the next slide, I cannot move the slides from
It's okay.
So
here we are.
So if you go to the next slide, one thing that everyone always looks at is wages. And that's normal because that's a very important driver for price changes. And wages have started slowly to go up. So I'll show you in the next chart some numbers. But then there are other drivers which are not very well discussed. And one driver is import prices. And this, again, only very recently have started to increase also in relation to the oil, because also European, on the continent here, we don't have much oil except in Norway. And then, which is not in the EU. Of course. And then there is another factor, which is producer prices. And there is very interesting dynamics happening. And I will explain that in the next charts. But if you put all of this together, what we see is that there are some signs that inflation pressure is building up in the euro area. But this is bad news for companies because it looks like there is companies don't have pricing power. So they cannot transfer these price changes to consumers.
So why don't companies have no pricing power? I mean, wages are increasing in Europe. Consumers are quite confident. So why would companies in Europe not want to pass on some of this to the consumer?
Well, it's very difficult to tell, but one reason I can see is the fear of losing competitiveness. So the idea is to try to stay at any cost as competitive as possible and don't lose market shares via this.
Okay, so Brian, is that true for the US too, that passing on these prices to the consumer is tough because of competitiveness consideration, or is it easier here?
I would say it's still difficult in the US simply because there's a lot of concern about price comparability, increased competition from online. And I think some of those same dynamics may be playing a part in Europe, where firms are simply wondering, if we raise prices, are customers all going to defect to online purchasing?
Okay, great. So Ilaria, take us through some of your slides to build your argument.
Yes, so in the next one, you can see the wage increase. So there's been a change in the last 3 quarters. Before that, it was in the range of 2%, and you can see that at the end, towards the end of the chart, it is increasing. So the latest figure that we have is for Q1 of 2018, and that's 3.5%.
Right, that's actually quite interesting because it's actually perhaps even somewhat faster in the United States.
That is certainly true. The question is that sustainable? I think thinking of the euro area as one unit with regard to labor costs is hard because you do have particularly strong growth in Eastern European countries that are still catching up.
Because a lot of this area, I think, is Eastern Europe and Germany, right?
Well, not all Eastern Europe is in the euro area, so there are some countries like Slovakia, but not all of that. But also there, in a couple of months ago, in the Econ Watch a couple of months ago, we put down some numbers. And of course, wage growth is faster in Eastern European economies for a broad range of factors. There is a little bit of catching up, inflation is higher.
But then Germany is a big deal here too.
But I mean, Germany is 40% of this, and inflation pressure are building up in Germany more than in other countries, as we saw from the previous chart.
Okay.
Just on the last chart, one more message is that this is nominal wage changes, and if I put there a long time series just to compare it to the last decade, so we are quite far from the previous peaks in this chart, which were above 4% or even above 5% before 2008. So just to give you an historical comparison. This slide you can see now is about import prices, which is another component that can drive inflation up. And there you can see towards the end of the chart, a pressure down, but then a little uptick towards the end. So I would assume that if oil prices continue to increase and the euro devaluates, this will be a driver for higher inflation down the road. And then I want to go to producer prices because there are very interesting dynamics that we found out. So you can see that I was very surprised, honestly, of this because in 2017 the economy was very strong. So I would have expected the growth in producer prices to move exactly in the opposite direction compared to what you see here towards the end of the chart. So producer prices really struggled to take off despite the strong momentum, the strong growth of 2017. And I tried to look a little bit in the details of for what type of goods. So if you go to the next slide, you can see that there are two types of goods in particular that are driving it down. It's very small here. So one is the intermediate goods and the other one is the durable consumer goods. So there are these two items for which the trend downward is particularly strong, whereas the other two, it's more flat. So I thought this is another interesting piece of information.
And why is that, Ilaria? Why is it particularly those goods? Is that because there's a lot of competition there? I mean, you made that competition argument earlier.
That's the only one I can think about, honestly, because I don't see. I would be happy to hear another explanation for this. But the competition argument actually comes back in the next slide, because you can see in the next slide the difference between producer prices for goods sold in the euro area and goods sold outside the euro area. So the outside the euro area is the pink chart, is the pink line, and the green one is for goods inside the euro area. So you can see that the line for the extra EU and the drive down is even stronger. So it looks like producers are not able to increase prices in the euro area, but they are even less able to do so for things sold outside the euro area. So it's like we are to some extent importing, exporting deflation on both sides.
Yeah, so this is the euro area and outside the euro area, but many of them are in the European Union. So one explanation that I would have that maybe the single market for goods, which has been there for a long time, rather than for services, is finally working. And that we're still benefiting from the fact that single market is creating a more competitive environment in the goods sector of the economy, where you see the biggest declines.
That is true, but then it means it's working too well in the sense that a little bit of inflation is good for the economy because it signals that the economy is alive, there is activity going on, and it looks instead like this has not been the case for a long time here, and maybe the single market is adding pressure to that.
Yeah, so you know, I think with the pricing power, it's always an issue if you're in a very competitive environment, and if that is generated by a single market, for example. It puts downward pressure on prices. The only way you can create upward pressure in prices then is to create more value, niches where you can actually charge higher margins. And that is perhaps still a bit difficult for many European economies, for many European companies to do in this environment where where this recovery is still kind of ongoing. So that could be one of the explanations. We need to wrap up. We're sort of approaching the top of the hour. Brian, any sort of final comments? Why is this an important topic we need to keep watching here?
This is an extraordinarily important topic because right now the cyclical dynamics in the US, to a lesser extent in Europe and emerging markets, suggest that inflation should be picking up rapidly. There's some evidence this is the case, but not quite as much as the cyclical dynamics suggest. And so I think from a long-term strategic perspective, businesses need to think about why this might not be happening and what changes to the structure of global economies is occurring that's causing inflation to, over a long period of time, remain below what you would expect from the cyclical dynamics.
Yeah, and I would perhaps add, just from a historical perspective, inflation can be sort of stable for a very long time, and then it can rather suddenly pick up and accelerate. And quite often you're behind the curve. That's why central banks quite often respond too late to this kind of inflation boosts, and particularly given the fact that we haven't seen it for a long time, we risk of being complacent around this. So we'll keep watching this, and that's why Economics Watch is there. So please stay with us every second Wednesday of the month. Again, we'll be back on July 11th. Then we will actually have, of course, again, our outlook, but then we'll pay some specific attention to labor markets in the US. We already talked a little about that when it came to the occupations and the differences, but also large differences between states in the United States, which Brian, together with our colleagues Gad Lebanon and Frank Stemers, is going to look at. And then there are some related resources, including, Brian already mentioned, our Window On series, which is a virtual panel kind of discussion, which is going to be next week on June 20th, and it's going to be on the retail sector, so strongly related to what's going on here in terms of declining margins and slowing prices, and there's some other things that you can also potentially look at. Brian, Ilaria, Abdul, thanks very much. Great conversation, important stuff. And I hope you will all, first of all, have enjoyed it and got some benefit from it. And again, feel free to share with your colleagues. And finally, there is an evaluation at the end. So please, give us a little bit of feedback. It helps us to keep this program going. We hope you see you again on Economics Watch next month. Thank you for joining us today. My name is Bart van Ark, Chief Economist at the conference.